Well, hey there, everyone. Happy Thursday, July 24th. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller. Great to be back with you today. It's a beautiful day. I actually spent most of the morning into the early afternoon working from the back porch. It's that kind of day here in the Pacific Northwest. High in the upper 70s, clear, no humidity. I'll take it. There are other parts of the year that are a little more challenging weather-wise, but this is one of those great times. So I hope wherever you're at, you're enjoying some good weather and enjoying some market activity. Interesting week for sure. And a number of things I want to go through with you here in our time together. One would be, sort of this, I don't know what you call it. It's not really a failed breakout because Alphabet has already been going higher, but sort of an underwhelming post-earnings reaction from Alphabet and Tesla. So far we've had three of the Magnificent Seven stocks reporting earnings this season. Netflix, which has basically been free falling since its report, Tesla, which is down 8% on news around earnings that, could be a more difficult period for sure, with a lot of headwinds to electric vehicles that were very much tailwinds with federal support going into this year. And then Alphabet, which probably the most encouraging earnings in terms of the, AI discussions and all that, but the stock kind of opening higher and closing lower. So this, it's a very interesting time. We're having the previous leadership start to struggle here, and if semiconductors are kind of their own thing. Semiconductors are still generally looking quite good. Like Nvidia is still in a clear uptrend, but other parts of tech are not looking as ideal. We're seeing other areas of the market like healthcare and random other things like in industrials and healthcare and energy and random utilities just all of a sudden starting to look pretty good. So this very much feels like a rotation. And this kind of, in this environment, usually can go one of two ways, of course. I mean, one would be a healthy rotation from technology leadership to other leadership that allows, propels stocks higher, even if the benchmarks probably struggle a bit because the leading names are down a bit. Or the weakness in Magnificent Seven types of names start to go, force people to go more risk off. And instead of rotating, it's more just rotating out and just trying to unwind positions, in which case market starts to go down again. And so I think, the good news is the charts are going to tell us which of those scenarios plays out. I think this is an important time to just track the trends, right? And just see, number one, with the major benchmarks, which of course we will as always. But we'll also look at some of the leadership themes and which stocks are struggling and which stocks are starting to emerge. As a reminder, we are live streaming on Facebook, LinkedIn, YouTube, and X, and I appreciate you guys so much, those that are tuning in live. Great to have you here today. Please drop questions as we go. Makes the show interactive, gives me some things to talk about and think about, and I'll take one or two of those questions at the end of the episode to answer. Anything we don't get to, we'll put it in the mailbag. Planning an all mailbag episode tomorrow on Friday, July 25th, and we'd love to answer one of your questions on the show. All right, let's look at some charts here together. So the S&P ended up trading slightly, a choppy session, but at the end of the day, ended up finishing just slightly above where we finished yesterday's session. You can see on the left half of your screen, here's yesterday with just this brilliant uptrend, closing above 63.50 for the first time in history. Earlier in the day, it looked like 6,400 may finally be checked off as a new upside threshold for the S&P 500. We did get to 6,380, but then sold off in the last half hour. The S&P did remain in the green, but not by much. So slight gain from yesterday with the S&P closing around 63.63. The NASDAQ composite, 0.2% higher, not much of an update by any means. Similar kind of trajectory, pulling back in the last hour. The Dow, however, opened low and stayed low. It actually closed near the lows of the day, closing below 45,000 after closing just above 45,000 yesterday, kind of coming back down. We're currently around 44,700 at the close. Mid caps and small caps down, and the S&P 600 small cap index, the worst of them all. And again, the question, when are small caps coming back as a leadership theme, that has been thrown around in discussions I've been in for years. And the answer still just appears to be not today, right? That's sort of the general way to answer that question. I mean, at this point, betting on small caps just seems like you're fighting the general tendency in the market for multiple years here. We've had little fits and spurts where small caps have outperformed, but not sustainable. So today, small caps down 1.6%. The VIX, not much of a change, basically still around 15.4, right about where we were yesterday. VIX below 20 means low volatility. VIX below 16 means pretty much extremely low volatility. This is a slow and steady uptrend, and that's pretty much what the chart of the S&P and the NASDAQ tell me, right? Market's going higher. We're going up and to the right. The VIX remains very, very low. I'm going to assume that that keeps going until it doesn't. Now, there are plenty of reasons why the market could go lower, right? Magnificent Seven earnings continue to not be awesome, while other things have better quarters in the earnings release. The negative outcome on some of those leading growth names pushes the market lower. Some sort of tariff headlines, some sort of other headline we haven't come up with yet. And I mean, there's so many things, right? It's just the seasonality, the fact that we're going into August and September, which is probably the weakest 2-month stretch of them all. All of those things tell me the market probably shouldn't be going much higher. However, as a trend follower, I consider my main goal to be following the trend, and the trend is up, right? Today, even we're continuing to make new highs. So plenty of reasons why we could see a rotation, plenty of divergences. One new one that I found today that I'll highlight for you. But from a trend following perspective, trend's still quite positive here. Rates generally drifting higher. The 30-year point wasn't much of a change. The 10-year point did push up a little bit. So the 10-year is right around 4.4%. The long bond is right at 4.95. It was almost about 5% earlier in the day. The dollar index, not much of a change, up slightly from yesterday, but it hasn't really moved a whole lot here this week. Looking at the commodity space, actually kind of mixed. You can see gold and silver, the two precious metals that we track here using commodity ETFs, both down today. The silver ETF, the SLV, was down 0.6%. Crude oil up. The USO, which is a bullish crude oil ETF, finished up about 1.1%. That drove energy to be in the leading spot out of the 11 S&P sectors today. Looking at cryptocurrencies, Bitcoin flat, Ethereum up 3%. Ethereum over Bitcoin, I mean, that's one of those interesting ratios. So often I feel like we think of crypto as a thing, just as one thing. Just like it's kind of like thinking of commodities as like one thing. And when you have to remember, in commodities, there are actually quite a few different types of commodities, right? You have the energy space, you have soft commodities like agriculture, you have hard assets like metals and gold and silver, precious metals, industrial metals. There's a bunch of things kind of in there. And cryptocurrencies, you could make the argument, it's probably not quite as diverse, but it's certainly, they're not all the same, right? And there are different themes at work here. So you can see some general consistencies and correlations between these, top 10 coins on the stock charts platform. But often they can diverge. And today you've got Ethereum up about 3%, while Bitcoin is flat, currently just below 119,000. All right, looking at the 11 S&P sectors, as I mentioned, energy was in the top spot, but only 3 S&P sectors actually finished in the green today. There were more in the positive up until the last hour of trading, and that's when things started to rotate lower for the equity indexes. Energy, the XLE up 0.7%, technology number 2 up 0.4%, communication services, which does include Google, which was up slightly, just not as much as it was in the morning. Up 0.2%. On the downside, consumer discretionary certainly weighed on by Tesla having a pretty brutal post earnings after party. The XLY was down 1.7%. Materials down 1%. Healthcare and staples both down about 1/3% today. Other things to tell you, we've been highlighting how the breadth has actually been quite strong, and I think that's been one of the, kind of saving graces, or at least one of those factors that makes it feel like this market is in pretty good shape. The fact that breadth conditions have been pretty good, and overall the trend in breadth is still quite strong, right? The cumulative advanced decline lines are all trending higher above the 50-day moving averages. As I'll show you when we get to the chart review portion of the day, new 52-week highs, right? Monday and Tuesday, Wednesday of this week, we're seeing a decent number of S&P 500 stocks making new 52-week highs. That's encouraging. General advanced decline data has been more positive than negative, but today, not the case. Today, you can see that the breadth was actually more negative, kind of a 2-to-1 ratio on the New York Stock Exchange, about the same on the NASDAQ Composite. The S&P a little more close to neutral, right? You can see it's kind of color-coded neutral amber. This is the very bearish color scheme on stock charts when something's really out of whack. So 83% of the S&P 600, that's a small cap benchmark, 83% of those members were down, only 17% up. So we continue to have large over small, but today, even though the benchmarks were up, the breadth was retreating a lot more than the headline numbers on the S&P and the NASDAQ may suggest. All right, looking at some of these leading growth names, which again, I think are so important to follow just because of how big they are in our benchmarks. They have a ton of influence on the benchmarks. So when Tesla's down 8%, it impacts the benchmarks, right? In a non-zero way. If the 400th largest company in the S&P is down 8%, it's not going to register on the chart of the S&P nearly as much. So for what it's worth, Broadcom and NVIDIA and Amazon having decent updates, all up about 1.7, 1.8%. On the downside, Tesla down 8.2%. That's after earnings yesterday. Apple kind of flat for the day. Meta kind of flat for the day. Netflix actually managing to bounce higher, 1/3% after retreating pretty much every day since reporting earnings last week. All right, let's continue on and look at the market carpet. By the way, please keep your questions coming on all those platforms that I mentioned if you're tuning in live. And if you are tuning in to the replay on our YouTube channel, thanks for watching. I appreciate it so much. Please leave a comment with a question you'd like me to answer. Maybe we can get to it in our all mailbag episode. Quick heads up, some activity in the Market Misbehavior podcast. My interview with Adam Koch is now live. We put that out yesterday. Adam is a financial advisor and advisor coach based in Columbus, Ohio. He's a fellow Ohio State grad. So we did start off talking about the joys of being an Ohio State fan and the absolute soul-crushing reality of a life as a Cleveland Browns fan. We are kindred spirits with both of those teams. It's the good and the bad all together. But we also talked about a lot of really cool chart stuff. And if you're an advisor, I think you'll find it a really cool discussion because I think Adam does a fantastic job of using technical analysis and charting to inform his own decision-making and his own positioning for himself and his clients' portfolios, but also to have a meaningful dialogue with his advisor clients and enriching that relationship, using technical analysis as a language to have a good conversation about what's happening in the market. So some really interesting, thought-provoking comments there. Also, I had a great time earlier today interviewing Bob Pisani. Bob, you most likely know after 30 plus years on the floor of the New York Stock Exchange as a senior markets correspondent for CNBC. He stepped down from that role earlier this year. I immediately reached out to him and asked if he'd come on the podcast. He agreed. We recorded that earlier today. That should be ready for you tomorrow. I tell you what, talk about someone who has an absolutely endless supply of awesome stories from the floor of the New York Stock Exchange. Bob's pretty much it. He's been around for all the highs, all the lows, all the really fascinating people that have come across the floor of the exchange. He's met them all. Used to chat with Jack Bogle on the phone all the time. I mean, some really interesting, thoughts about investing, about investor behavior, trading, timeframes. How you, just the challenge of short-term versus long-term investing. Really good thoughts in there, and I hope you enjoy that. Should be ready for you tomorrow. All right, looking at the heat map here, the market carpet. It's funny. I've thought of this rally off the April low, right? Once you sort of recognize that the markets were improving, you sort of recognize strength coming off the lows. Clearly technology, and then other things, right? It's like it's always been tech. And then randomly something else that's been good for a while, and then it kind of goes, right? So it was like tech and industrials, and it was like tech and consumer discretionary. At one point a little bit ago, it was tech and financials, and then it was just technology. I almost feel like now when you look at it, it's like it's not as much all technology because you have like IBM getting dinged today, you have Intel down. I would almost say it's like semiconductors, energy, and Blackstone. I think it's the semiconductor energy Blackstone rally, the SEB rally is what I'll call this now. I mean, because Blackstone is one of those financial stocks that is just continuing to go higher. There's certain names that are just looking very, very good, but it's not everything, right? I mean, it really is sort of a mixed bag of colors here on the heat map today. So in the upper left, you can see obviously semiconductors, Intel aside, which is a bit of an outlier. I mean, it's one of those out of all the semiconductor names, there's kind of like the average, most semiconductors, then Intel's kind of this other thing, right? Business model is a little different, different type of company, although all labeled within semiconductor. So Intel aside, you have NVIDIA, Broadcom, KLAC. I mean, I'm looking at a random, kind of picking out random semiconductor, AMD, of course, all pretty good days today. And so the SMH still looking very, very strong as a chart above the 21-day EMA, which is above the 50-day moving average, which is above the 200-day moving average. That looks pretty good. But at the same time, you have IBM. I mean, literally looking like it's falling off a cliff here today, down over 7% today. I did grab that chart so we could look at it in a little more detail. So within technology, some questionable charts emerging, and IBM is a challenge. I think that's a concern because the market feels a certain way in like June when all the IBMs of the world are just going higher, and we've seen that on a number of different sectors where charts look quite strong, right? Honeywell making new 52-week highs at the end of June. All of a sudden, mid-July, and Honeywell's down 6% and potentially making a lower low. So you're starting to see, this is what when I talk about leadership rotation, it's like a bunch of things were working, and now some things that were working are definitely no longer working in some short-term or some very long-term way. So I guess the changing leadership is certainly a top takeaway. Also, just look at all the different kind of random red dots that you see or boxes that you see here. A lot of these are earnings related because we're in the meat of earnings season, where every day you've got a bunch of S&P 500 names and a bunch of other companies all reporting. But in technology, in consumer discretionary in particular, this is where I'm seeing a lot of red today. And it's not just Tesla, which we'll talk about, down about 8%. Chart's still, more sideways, right? It's still more range bound. It's still more in a consolidation phase than anything, but you have Chipotle absolutely taking a bath. You have the gambling stocks like Caesars rolling over. We've got home builders like Lennar coming down today. Starbucks pulling back after making a new swing high. And so the challenge to this market is these kind of charts, which have been pretty good charts, right? These have not been amazing charts, but they've been pretty good charts. Like amazing charts, I would say, are like NVIDIA, right? Making new 52-week highs, like long and strong, will these ever go down again kind of charts. But then you have clearly bad charts, right? That are just not working. But then you have like the middle, right? You have the middle of the bell curve where there's some okay charts, and the okay charts have looked pretty good. And what concerns me are the Starbucks charts of the world that look a lot like bearish divergences to me. And I think the problem is if this part of the market, right, sort of those okay charts go from okay to not so okay, that's when things can start to feel a lot heavier because random things you have in your portfolio just start to not work anymore. Now, if that's the case, then breadth indicators should start to get pretty bad. Breadth indicators have been pretty good because charts like Starbucks are pushing above their 200-day moving average, and that's what's making things feel a lot better as an equity investor. Starbucks today back below the 200-day moving average. Not the end of the world yet, but not great. And, again, I think the chart like this is really believable if it can get above the 200-day and hold that. But the divergence suggests to me that that's probably not the most likely outcome here. Now, we did have a divergence on the S&P 500. I would argue that divergence is no longer very, very clear, no longer, probably relevant at this point. But on a lot of individual stocks, I'm still seeing those kind of divergences for sure. What else here on the heat map? T-Mobile, right? The other thing that I would point out is that when you do have rotations, right? When you have things like Honeywell and others that have had these really good runs and are starting to rotate lower, the question is, well, what is starting to work? There probably something somewhere is starting to break out. This is why I often scan for stocks making new 3-month highs just to try to surface charts like this. This probably didn't technically make a new 3-month high. Yeah, it's like, well, we're still not quite to a 3-month high here, but you get the idea, right? We're below a downward sloping 50-day moving average until today when we gap higher. We're below the 200-day moving average until today when we gap higher. The RSI consistently below 60 until today when it breaks above here. So charts like this, making a higher low around 225 and then springboard style bouncing off of there. pretty impressive rotation. I kind of like that. I like that kind of move. So those are some of the opportunities I think that could be compelling here. If you're owning things that are starting to rotate lower, I'm happy taking some off the table there and rotating into things that are starting to rotate higher. The idea, I think, as a stock picker, if you use technical analysis, is to follow trends as long as they work, and when the trends no longer work, start to get out of those and start to rotate into things that are working, right? And looking at for some of those new emerging leaders can be really valuable. That's where scanning is such a lifesaver in helping you identify some of those names. That's probably enough time spent on the market carpet. I could spend all day looking at this, and I often do. I often have it up on a monitor, just kind of looking at it and looking at different themes and zooming into things and seeing what they look like. Huge fan. All right, let's finish off looking at some charts. We'll take a couple questions. We'll be good to go. So here's the daily chart of the S&P 500. As I mentioned, I'm still seeing plenty of divergences on individual stocks, but I would say for the S&P and the NASDAQ, looking less like a divergence. Here's what I mean. Divergences are not perfect. As a matter of fact, I just sent out my newsletter earlier today, and I quoted Justin Mamis. Justin Mamis, quick story. Justin Mamis, famous market practitioner, really consider him a technical analyst, although he was a broker, I believe, at Morgan Stanley. Is that right? I'm kind of making up this story. So let me not just start throwing around firms, and I'm not sure. I'm pretty sure that's where he was at the time, but that might not actually be true. One of my analysts at Fidelity, my former analyst, had worked directly with Justin, and so I got to know him just a little bit through Mark. And Justin wrote a number of really cool books. One of them was something about like know when to sell, which I thought was really good about just like basic ways to recognize when a chart was not working anymore. And he had a different book talking about when to buy and just timing aspects. But his famous quote on divergences are like laxatives. You never know if one is not enough or two is too many. And I think that's a great quote, because what happens is when you have a consistent uptrend, this is what he was getting at. Like with the S&P, we had a divergence back here in May and June, which we talked about on the show. And when you see a divergence, you have to remember it's a leading indicator, but it's not a guarantee that things are going to top out. And I think sometimes people get a little too excited seeing divergences because they think, all right, I should sell because it's a divergence. For me, the divergence on its own does not tell me to sell. That tells me to put it on a list that I watch closely for signs of a breakdown. The sign of a breakdown, right? Breaking the 21-day EMA, breaking a key trend line, weaker volume, weaker momentum. Those are the signs that tell me, okay, the divergence was pretty good because this is now rotating lower. But the other way that this can resolve is the market ends up going higher on stronger momentum. It's not a divergence anymore because we're making higher highs on stronger momentum again. And we highlighted this earlier in July because we're seeing the market move higher on weaker momentum. But this week's price action as we move to new highs is with stronger momentum. So it's not a divergence anymore, right? I mean, we're moving higher on stronger momentum. So it doesn't mean today isn't the top. It might be. I don't see anything today telling me this is the top. That's something I wait for a breakdown to confirm that. But the divergence that you may be looking for, I don't think there anymore. Having said that, everything else we talked about, I think still very relevant. The 21-day EMA, in my opinion, is kind of the thing to watch in this sort of environment when you have a position or an index or an ETF that's trending higher, and you want to make sure that you follow that trend as long as possible and lock in those gains, and then just get out at a reasonable time if we do get a top. That's a really good level to watch. For now, we have a healthy gap between the current price and that 21-day EMA. This is a breadth indicator I haven't talked about a ton because it hasn't really been making a lot of noise. But this week, things starting to change a little bit because on Tuesday and Wednesday, this is not updated for today's trading just yet, I don't think. Although that might actually looks like it is updated for today as I'm looking at it, which means it's saying about 10%. It's about 9%, right? 45 out of 500-ish S&P names. You made a new 52-week high today. So that means yesterday that's, just over 10%. Today, around 9% of the S&P. So it's about 10% of the S&P this week making a new 52-week high. That's not nothing. Now, it would be better, right? And in sustained bull phases, you'll get much higher. And you'll get up to 25% of the S&P making a new 52-week high on one day. Today, we're down more in that 9 to 10% range, but that's still 50 out of the 500 stocks making a new high. So The bull case from here, you really want to see more and more stocks making new 52-week high. I actually think that's encouraging. We'll see if that continues. Divergences are out there, though, and I would say small caps definitely showing a pretty good divergence here with higher highs in July marked by weaker momentum. I think the idea that small cap is leadership, it's not there yet, right? And I think the relative performance has not been particularly strong. It's been a chronic underperformer, and that's really less to do with risk appetite of investors and more to do with the calculations of these indexes. There's been such a gravitation toward the mega cap AI, tech, and communications kind of names. That's not what the Russell 2000 is giving you. The Russell 2000, you're getting exposure to sectors like healthcare and materials and regional banks and stuff like that. And some of them are doing fine, as you can see by the fact that the price is going up, but not as good as those other mega cap growth stocks. So, the chart from a technical perspective still okay. I'm watching this 215 level, which is a Fibonacci level, and the 200-day and the 50-day moving average kind of all around that point. So I think as long as it holds that, it's pretty good. However, the divergence tells me it's most likely, still going to underwhelm versus the large cap indexes. Thursday is a great day to review some sentiment indicators because they're published on Wednesday and Thursday. And here we can see the AAII survey narrowing a bit. So bulls down slightly to around 37%, bears down slightly to around 34%. What this implies is you had some bulls that went neutral. You had some bears that went neutral. We're kind of less opinionated today, I guess is how I would say it. The gap between the two still slightly favoring the bulls, but that's really more of a neutral reading for that particular indicator. The name exposure index, which is a survey of money managers and asking their allocation to the equity markets, has been steadily coming in the last 3 weeks. It's still probably right about the average reading, right around 80% in terms of the average kind of mean response from this weekly survey. So we've gone from very bullish about a month ago now to more neutral positioning in terms of money managers in that survey. But it shows you that into this strength, this survey is actually showing less optimism from money managers, kind of fading this rally here. All right, let's talk about some individual stocks. So Alphabet's overbought. That on its own does not concern me a ton. That just means it's gone up a lot. But what you do is you look for signs of distribution. Today is not a bearish candle pattern that I would cite. It might be one, but not a common one and not one that I've used consistently by any stretch. But it certainly doesn't feel great, right? I mean, if you look at what happened on this chart, here's yesterday's close right around 190. Here's today's open around 197. We went slightly higher, but by the close, we're back down to 192. We're back down within yesterday's range. So the issue here isn't that it's a bad chart. It's not. It's still going up, right? We're still making higher highs today. However, the intraday sentiment was not strong, right? It's telling you that investors were selling into the strength out of the open. Alphabet gapped higher, and traders are like, thank goodness, unwind, let me sell out and take some profits. Otherwise, the price would have just spiked higher. And that's why you have that gap and run mentality with a lot of charts. Alphabet kind of an underwhelming follow through. So, again, it's like on a short-term basis, that tells you there's sort of a lack of upside momentum right here. Is it a bad chart yet? I mean, not even close. I don't have the 21-day EMA. We'll add that on here just to take a look. But that's the kind of, I'm fairly certain it's still slightly above that. Actually quite above that, right? So here, let's go back. Sorry, I'm just going through a bunch of things here. All right, let's go back to the chart of Alphabet. There we go. Now we've got the 21-day EMA in green. So I mean, we've got a lot of room before that would look like a bad chart. So in this kind of thing, it's like anything above 182 is still pretty good, right? And we might have some choppiness, but if we would break below there, that's what would tell me, okay, we're really starting to see some disbelief in the chart and some downside momentum, some real selling pressure. For now, it's just a lack of follow through. Definitely not ideal. Speaking of not ideal charts, here's the chart of Tesla. More and more just minting this absolutely textbook coil pattern or a symmetrical triangle pattern. This can happen in any kind of environment. And it's basically just the market in an equilibrium, right? We have highs getting lower. We have lows getting higher. We're kind of settling in. The market is basically saying, Alphabet is worth $320 a share. And it's known that since kind of back here. And now we're just kind of, swinging above. We're just kind of pendulum swinging back and forth above that equilibrium price. So the buyers and sellers are generally in agreement. And what happens in this environment is you patiently, or the general practice here is you patiently wait for this pattern to break. So one of two things is going to happen at some point, arguably very soon, is we either break above the upper boundary, the upper trend line from the highs, which suggests a nice bullish breakout, or we break below the lower boundary. And we finished today just above 305, and that's slightly above 300, which is where that trend line currently sits, which means a little more deterioration tomorrow. And this looks like a coil pattern resolving to the downside, which would suggest much further deterioration. I mean, from a technical perspective, that would basically say, most likely scenario is a retest of the March and April lows. Because what you generally do here is take the height of that pattern, subtract it from the breakdown that kind of gets you down to that general range. That would be an obvious next step, I think, using the best practices of technical analysis there. Airlines coming off here, you can see Southwest actually reported earnings yesterday. It did not go well. Stock down just over 11% today. That means in one day, we've broken below the 21-day EMA. We've also closed slightly below the 50-day moving average. After a day like this, right, I mean, you have to wait and see what happens tomorrow. Do we get a follow through where the stock, closes a little bit lower? And in that case, I think it's certainly a cause for further deterioration, most likely. IBM gapped lower. I mentioned I would show you this. Now, it's been toying around with the 21-day EMA here for the last couple of weeks, which immediately makes it a less than ideal chart. Other charts have been looking better. Today, we gapped below the 50-day, and we gapped all the way down to kind of the 50% retracement here of the overall range. Today is indeed a hammer candle. That's when you have the open and close near the upper end of the range, long lower shadow, little to no upper shadow. That suggests the next 1 to 3 bars are bullish. So we're oversold as we get that hammer candle. That suggests some optimism coming in here. So I don't have a position on IBM as like a swing trade or something, but if I would have taken it on today, I would basically structure it as that's the position. I'd probably use this as a stop because this is the 61.8% retracement of that uptrend, and it lines up almost perfectly with the 200-day moving average. That's around 245. So I think as long as that holds, that could still be a good long-term structure and sort of be within, a reasonable pullback within an uptrend phase. But a big down move on heavy volume, not great. I mean, obviously not good. We'll see if there's a bounce using that hammer candle and everything. But overall, I'm less excited about that chart than I was a month ago for sure, right? You can see, I mean, this is the issue that I'm seeing in this market here, even though the breadth has been okay. The market had a look and feel in late June when all the IBMs of the world are in an uptrend. And I'm seeing a lot of these charts that are starting to gap higher. And the question is, do new things really start to come in? And maybe we're seeing that in sectors like healthcare and industrials and financials, as we mentioned. But is that enough to keep the major benchmarks elevated? I'm not so sure. All right. Great questions in here. I'm seeing as I'm going, I'm glancing over and I'm like, oh man, these are a bunch of really cool ones. So I'll try to answer as much as I can. Yeah, let's see. Richard, thanks for watching on YouTube. I'll take a couple quick questions here. Do you think that the leadership change is occurring because of the tariff deadline on August 1st? I mean, it's just so hard to say, right? And I think that's a big part of what you do as a strategist is, and it's funny, man, I do a lot of interviews, as you may or may not see in random different outlets, and people love to ask about all these different things and attribute as if we all understand each input and how that lines up. I mean, anyone that tells you this is what's happening and this is what tariffs are doing and this is what the Fed's doing and this is what is happening with geopolitical and this is how stocks are relating to all those things, it's all a lot of guesswork. I mean, it really, really is. And people can speak from experience and give you a sense, a narrative of how they think it might be related, but none of us really know. You really, really don't. So it's really hard to see if the leadership change is, because of, investors changing, perceived further earnings growth because of the impact of tariffs. That could certainly be it. I know a lot of investors right now, reasonably so, are motivated by companies that they think are going to survive and thrive and struggle given some expectation of what tariffs are going to be. I mean, the reality is we still really don't know what the lasting impact is going to be. Anyone that tells you this is what tariffs are going to do, we don't know. I mean, it's a guess. It might be a very educated guess, but it's still not a no, or we don't know what's going to happen because it's never really been done in this particular environment with this particular market structure with all the other things happening in this big financial machine. So is that a part of it? I think that's a part of it. I think the Fed, and expectations about lowering rates are part of it. I think the normal seasonal tendencies, and this is when investors tend to realize that's kind of where we're at and starting to get a little more defensive. I would not be surprised if that's a part of it as well. But I think regardless, we're definitely seeing a change in leadership. And I think that is true. We can very much guess on what all the different motivations are. But again, the markets are quite a complex system. It's combining a bunch of different things to come up with that total picture. I saw one other question here, and I should have grabbed it. There's a way you can actually flag them and come back to them, and I always forget to do that. Alex, I don't know if I've answered one of your questions on the show before, but I do see you on there asking about Dave. Let's look, ticker Dave. I try not to overplay my hand on the fact that there's a company called Dave Inc. I used to work early in my career. I worked at Bloomberg with an awesome technical analysis mentor named Sean Waters, who works at Bloomberg on the execution side of the platform. Shout out to Sean. He was just an awesome early mentor, just had fun talking to clients, talking about charts. And I picked up on that immediately and loved him. We used to travel quite a bit together. He used to love to use Waters Corp because his name was Sean Waters. So we always had that. It was like the running joke that he would always bring that up as the example. If I was doing that today, you better believe Dave Inc. would be featured on every presentation that I do. From a technical perspective, so, Dave has actually had a pretty incredible run. It reminds me a lot of like the chart of Palantir, or one of these where the chart looks very normal. It looks very kind of normal volatility, but these are huge percentage swings. So it can be very, very deceiving. So just this move from the April low to that peak, that's a 340% gain in Dave from that low to that high. So just the magnitude of the swings are pretty significant. So here's what I think about this stock, because I actually do follow this one pretty quickly. I would say it's very, very close to looking like a fairly ugly chart, and I'll tell you why. Right here was that pullback that we had in June. We made a new all-time high, almost getting to 390, but now we've broken through the 21-day EMA. We've now broken through the 50-day moving average. So for me, I'm probably, if I do own that, I'm probably partially out at least. But breaking to that new swing low, that's around 185. That would be a real negative breakdown. In my opinion, I'm going to set an alert for that, and I'll let you know if and when I would see that. But I think very, very close to going from. I mean, it's an okay, right? It's like a yellow light, green light back here, yellow light as we break initial moving averages. Red light is when we break down there. The 200-day moving average, if we would break down, that's where I would look for a bounce, which is what we had at the April low. So for now, hanging in there, but the breakdowns of the moving averages, I think, are pretty concerned. I'm not going to read too much into a name like Devil's Coins and what exactly you're talking about, but thank you for watching and thanks for asking about Toast, TOST. Great chart. I'm trying to think of if I've shown this on the show recently. These are a blur of sorts. I barely can remember what charts we looked at yesterday, much less in the last week, but I do remember bringing up Toast randomly. Toast came up on my screen just this month for making a new three-month high, right? So as I mentioned, one of the scans that I love to run are stocks making new 3-month highs, stocks making new 3-month lows. I think that's a really good working list to start with. There are a couple things that I kind of generally scan for just for idea, just to look for charts that are probably looking like interesting charts I want to be aware of. And that's where I often kind of handpick things that I would want to put in there. Toast definitely popped up on the list. I think this break above 46 is a nice breakout. It's the momentum is strong but not excessive. The relative strength has been very good for the last 12 months, but starting to turn higher. I think that's a really good chart. Moving averages in the proper order. Bullish chart until proven otherwise, I would say, for the chart of Toast. Folks, that'll do it. Thank you so much, as always, for watching the show. Thanks for the thoughtful, fun, and entertaining questions. And if you're watching our replay on our YouTube channel, thanks for putting the questions there as well. Don't forget to check out latest episodes of the Market Misbehavior podcast. We had Mike Singleton of Invectus Research, all things macro last week. Adam Koch of Libertas Wealth Management in Columbus, Ohio. And then Bob Pisani. That episode should be out tomorrow. Some great conversations. Please check it out and enjoy it. If you have suggestions on who else we should interview, let me know. For Market Misbehavior, I'm Dave Keller. Have a good night. And remember, it's always a good time to own good charts. Take care, everybody.